Hello everybody, this is a video about MSTR, video about strategy, but I'm gonna talk a lot about the Fed and the implications for digital credit and for the value of the preferreds of strategy. The 5 preferred are about to become a whole lot more valuable because yes, the Fed has cut rates, but that's not the headline. That's not the surprise. We had 97-98% chance of the Fed cutting the rate by 25 basis points. No. The surprise is quantitative easing starting this Friday, i.e. in 2 days. We have quantitative easing. Many pundits were thinking it would start sometime in 2026, not in 2 days. So the bluff has been very, very, very real, and it looks like, to me, Powell is giving up on the bluff. And they literally announced that the central bank plans to buy $40 billion worth of short-dated government bonds. This is absolutely insane. Why are they buying government bonds? Well, they're buying government bonds, short-dated ones, because no one wants them. That's why they're buying them. And how are they buying this? They're buying this through pure monetary printing. Unlike commercial banks who need to create the money and need to delete that money once they get repaid, that's not how the Fed works. The Fed doesn't need to delete the money when it gets repaid. The Fed just creates the money out of thin air. This is the primary layer of monetary printing. This is not the bulk of the money printing comes from commercial banks lending, but this is back to the era of 2020, and this is back to the 2008 levels. This is directly quantitative easing. This is QE. This is the government literally printing $40 billion, i.e. diluting the value of everyone's dollars to buy short-term bonds. As the famous 60-minute 2020 interview said, you had Powell explaining, we printed digitally. As a central bank, we have the ability to create money digitally. They print it digitally, and they're going to buy government bonds, inject money into the government, which then the government is the largest spender in the world, the US government, and so it's going to inject that into the economy. And then we are back to the money stock just growing like insanity. This is the money stock. This is the denominator. We don't know how big it is because nobody has any idea of how big euro dollars are. We don't know how big the foreign system, the foreign dollar system is. We don't know how many there are, but many estimate it's more than M2. And then we have M2, and M2, of course, I'm not showing you the chart from the Fed, but M2 has resumed its growth. So we're back to the original thesis of this channel, which over the long term, the money is getting diluted at about 15% a year. And this is just crazy, crazy, crazy. And here's the crazier part. He said that the $40 billion in the first month, it may actually be more in the upcoming months, up to tax day, up to April 15. He said they actually may inject even more than that. It's just pure money printing. And if you see the rationale for that, so the rationale is the Fed is saying, we don't know if we're going to rate cut. They're trying to continue the bluff. And they say, we don't know if we're going to cut rates more because, we have issues on both sides of the dual mandate. So it's kind of like if you believe unemployment is rising, and if you believe inflation is rising, well, that's the worst situation to be in, first of all. But then that's the second situation where you're stuck between a rock and a hard place. That's a catch-22. That's the situation where you have to do nothing, because if you raise rates, you're going to worsen unemployment and you're going to make inflation better. If you lower rates, you're going to ameliorate unemployment, but you're going to make inflation worse. So there's no winning in this situation. That's a corner. The Fed is in a corner. But my view on this, and I know people always disagree in short-term thinking, but my view is that the bigger risk is deflation. With technology, the bigger risk is deflation, not inflation. And if you actually dig into Powell's view of inflation, he's worried about inflation because of tariffs. Now, the view of Powell of tariff, in my view, is mostly ideology, and he actually said in the September one, he actually said that they did not expect in the September meeting. He said they did not expect the rise in inflation from tariffs as high as they had anticipated in April. So and of course, the truth from listening to conference calls is that tariffs are usually split 4 ways. Right? Tariffs are paid by customer, paid by lower margins, paid by the importer reducing the rates, and paid by currency devaluation from the importer. It's 4 ways. And I would argue that price hikes is the minor way that tariffs are absorbed. I would argue tariffs are more absorbed by currency devaluation and by the importer actually, cutting the margins. But of course, if you have an anti-POTUS ideology or an anti-New World Order ideology that we're in right now, new state, you're gonna be like, yeah, tariffs are gonna lead to inflation, and so. But my point is, and I'm not arguing about inflation. My point is, I think the new Fed chair is not gonna have that same view on inflation. And if the new Fed chair does not have that same view on inflation, we're gonna have rate cuts. We're gonna have a bunch of rate cuts. The Fed is kidding itself. They are kidding themselves, thinking they can keep rates this high, and they're trying to have their cake and eat it too here, which is they keep the rates high, but in the meantime, they do quantitative easing to finance just the government. But it's, so you're just a few layers away from actually reducing the rates for everybody. You're just a few layers away, because if the government just gets money straight from the Fed, freshly printed new money from the Fed, then they're just going to spend that money into the economy, and the money is going to come to the market. At the end of the day, you're increasing the pie. The pie of dollars is being increased at the end of the day. Bond prices are going to go up, short-term ones, if they buy bonds. Yields will come down. This is wonderful news for strategy because, of course, the delta between the yield on government bonds, quote-unquote, the risk-free rate, and the actual yield on stretch and all of your other preferred, that delta is going to widen. And if that delta widens, that means that it will need to reduce. And how do you reduce the delta? You reduce the delta by making the price of the strategy offerings go up. The price of the strategy offerings will have to go up because the difference between the risk-free rate and the yield is actually going to be even greater. Remember, the rate set by the Fed is just the overnight lending rate. It is not the market rate of the risk-free rate, quote unquote. The risk-free rate is about to be much lower because of that injection of liquidity, and we know that from the moment they open the liquidity valve, it's only going up from there. It's only going up from there. Anyways, MSTR, whatever. Who knows whatever MSTR is doing today? It's a little down while Bitcoin is bouncing back a lot. Very happy about that. MSTR is down. Whatever. Maybe he's ATMing on the common. That could be a reason. Of course, it's not ideal because we're stuck in the past where he was doing that at 1.8. Doing it at 1.15 is not ideal, but it is still slightly accretive. That's point number one. And then point number two, and I think this is something Saylor's realizing, and me too, by the way, I'm realizing that, is when even if you were to ATM at 1x MNAV, right? Or even slightly lower, like 0.95, even if you were to do that, you would actually benefit because you would increase the BTC rating of the prefs. You would make the prefs more anti-fragile. You would make the prefs less risky. They would be less risky because you would have a bigger bag backing those preferreds, right? And if you make the prefs less risky, the preferreds go up. And we know that Saylor's entire journey is to get stretch back to 100.01 so he can ATM like a madman. And he's doing a pretty good job if you ask me. Not long ago, we were at 93. That wasn't long ago, we were at 93, which has been bouncing back from that November crisis. So anyways, I'll finish with of course, we've had a lot of Middle East speeches from Saylor, two main ones I can think of. I want to just talk briefly about one thing that he said in the last keynote that really caught my attention. So he was talking about how Bitcoin being accepted as a collateral at banks is actually a really, really big deal. And it's a big deal for these banks. These banks are going to be able to make money because it's a big deal for monetary printing. It's a big deal for monetary printing, and it's a big deal for the banks. And he's mentioning there's a $2 trillion opportunity for banks to issue credit against Bitcoin. So what does he mean by that? If people move their Bitcoin to banks and they borrow against their Bitcoin for whatever reason, you want to do a home improvement or living expense or whatever, Where does that money come from? That money is created out of thin air. Commercial banks create money in the current fiat system we're in. Commercial banks create money when the debt is created. So, and of course, only the Fed actually creates money without debt, money out of thin air. And apparently, according to Elon Musk, it's not just the Fed. Apparently, there's half a dozen actual money printer within the U.S. government, which if you look at the U.S. Constitution, you know that the government has the right to print money in the U.S. Constitution. So according to Musk, apparently there's computers where you can print money within the U.S. government, but otherwise the well-known one is the one at the Fed. The Fed can print money out of thin air. A bank can only print money if it issues a loan. If it issues a loan, a bank can only print money. And of course, the banks always ever issues more loans, and that's how you grow the money supply with debts that never get repaid, because as soon as a debt is repaid with interest, you issue an even bigger loan and an even bigger loan. So what Saylor is doing is that there's a $2 trillion opportunity for money printing at banks, assuming they take on a lot of that Bitcoin that is not owned by STRD, a lot of that Bitcoin that is not owned by a bunch of people. Assuming they bring on a lot of that Bitcoin, you can create a lot of money against it. So it's a way for banks to make money. They can earn interest, right? You earn interest from your money creation. So the banks are going to make money. And the price of Bitcoin in dollars should also go up, because if you add another $2 trillion for monetary printing, you're increasing the monetary base, right off the bat. You're probably increasing it by 1%. If I look at the euro dollar and the M2, if I just look at M2 without the euro dollar, maybe you're increasing by 2%. So money printing galore is coming. And that's why Bitcoin is way too cheap, trading right now at 93,000 and change. It is way too cheap. This thing is going up, and we are seeing positivity in the market. This, of course, being the multi-party liquidation level links. I can see Binance is now liquidating some stuff to the upside. We had an awful day up until 2 p.m. and the Fed speech. I'm tired of these days. I'm really tired of these days. Having some geriatrics department just direct the cost of the market. As soon as we get back near zero or close to zero, these days should not matter nearly as much. And that's what we're gonna get with Mr. Kevin Dove Asset. Kevin Dove Asset, who's likely gonna be the next Fed chair. Anyways, this was not investment advice. This is not financial advice. This is just entertainment. I'm hoping you were entertained. Please like, please subscribe. Follow me on Patreon. Follow me on X. Thank you for watching, and have a wonderful, wonderful day.